Mandatum plc (MAN) presents a complex financial services investment case rooted in a dual strategy: the aggressive pursuit of capital-light growth through Mandatum Asset Management (MAM), alongside the managed high-yield capital return facilitated by the runoff of its over-capitalized, capital-heavy life insurance portfolio. The core investment thesis is predicated on the ability of management to efficiently extract and distribute excess regulatory capital while simultaneously achieving high operational leverage and double-digit profit growth in the asset management segment. This strategy is formalized by the target of achieving capital-light profit before taxes (PBT) CAGR above 10% and delivering cumulative shareholder payouts exceeding €1 billion between 2025 and 2028. I.1 Valuation Conclusion and Recommendation. The stock currently trades at Euro 6.07 to 6.32, near the high end of its 52-week range, 3.99 to 6.33, implying strong market conviction in the successful execution of this capital return story. This conviction drives the stock's valuation to a significant premium, with a price-to-earnings (PE) ratio of 21.5x, notably higher than the European insurance industry average of 12.7x. However, this market confidence stands in sharp contrast to the institutional analyst consensus. The target price consensus is Euro 5.48, implying an 11.9% downside from the current price, with a predominantly negative bias: 4 negative ratings versus 1 positive and 1 neutral. The high premium suggests that the market has fully priced in the successful realization of the ambitious capital distribution target. Given the tight valuation, the current price offers minimal margin of safety against execution risks, particularly concerning potential deceleration in growth quality or delays in capital payouts. The strong Solvency II ratio of 193% provides a robust floor, mitigating catastrophic downside. But the stock's appreciation potential is constrained by the negative consensus and the demanding growth metrics required to justify its current multiple. Recommendation: hold, neutral. The recommendation is to maintain current positions, awaiting validation of the capital-light PBT growth trajectory and the capital release schedule, particularly following the Q3 2025 interim report scheduled for November 11, 2025. I.2 Corporate Profile and Strategic Foundation. I.1 Company Overview and Post-Demerger Context. Mandatum plc operates as an insurance holding company conducting its financial services business primarily through its subsidiaries, Mandatum Life and Mandatum Asset Management. The group provides a comprehensive suite of services encompassing wealth management, savings, compensation, retirement plans, and personal risk insurance. The company was incorporated following the partial demerger from Sampo plc, effective October 1, 2023, with its shares commencing trading on Nasdaq Helsinki the following day. While Mandatum maintains its headquarters in Helsinki, it has operational offices in Sweden and Luxembourg, supporting its clientele across the Nordic region. The group serves a large customer base, including 20,000 corporate clients and 320,000 retail clients, with institutional clients extending into Sweden and Denmark. I.2 Dual Business Model Analysis: Capital Light versus Capital Heavy. Mandatum's financial operations are explicitly divided into 2 distinct segments, necessitating a bifurcated analysis of its performance. Capital-light business growth driver. This category includes unit-linked insurance products and the core institutional and wealth management (I&WM) business. Mandatum Asset Management (MAM) is the central vehicle for this growth, managing approximately Euro 15 billion in investment assets. I&WM is designated as the primary driver of growth, targeting Finnish and Nordic institutional investors and high-net-worth individuals, capitalizing on the firm's established investment expertise in fixed income, credit, and alternative investments. With-profit business, capital-heavy runoff. This segment represents traditional life insurance policies. The long-term strategy involves systematically scaling down this capital-heavy operation, While profitable, the financial results from this legacy portfolio introduce significant volatility into the group's overall reported earnings, total PBT, largely through market-driven fluctuations in the net finance result related to investment value changes and insurance contract liabilities. Therefore, the structural insulation of capital-light PBT growth must be surgically separated from the overall results for a proper assessment of sustainable earnings quality. I.3 Strategic Pillars and Financial Targets, 2025 to 2028. On June 4, 2025, Mandatum announced updated financial targets that explicitly reinforce its commitment to leveraging the capital-light business for growth and maximizing shareholder value. The key targets for 2025 to 2028 are Return on Equity, ROE, set above 20%. Capital-light profit before taxes growth, CAGR, targeted above 10%. Solvency margin, reduced to a range of 160 to 180%, from the previous 170 to 200%. Cumulative shareholder payouts, exceeding Euro 1 billion for the years 2025 to 2028. The strategic decision to lower the target Solvency II ratio to 160 to 180% is critical. This action is not a reflection of weakened capital, but rather a sophisticated corporate finance signal designed to increase capital distribution. By formally reducing the capital floor, management explicitly classifies a greater portion of the existing 193% Solvency II ratio as excess capital, providing the definitive financial basis for the ambitious Euro 1 billion cumulative payout commitment. This maneuver strongly confirms the centrality of the capital return narrative to the investment thesis. However, the pursuit of the 10% capital-light PBT CAGR target is subject to competitive pressures. As Mandatum accelerates its international AUM growth, particularly within the institutional client segment, there is a recognized risk that these new mandates may come with structurally lower fee margins, which would dilute the average revenue yield over time. If margin compression materializes, achieving the PBT growth target will require an even faster rate of net flow and AUM accumulation, introducing a hidden execution challenge for the years following 2025. 3. Operational Review and Growth Trajectory. 3.1 Assets Under Management, AUM Dynamics. The capital-light business successfully drove asset under management growth. Client AUM increased by 11% year-over-year (YOY) to Euro 14.4 billion as of June 30, 2025. This growth is a strong validation of the strategic shift toward the I and WM segment. Despite the robust overall AUM increase, the quality of growth shows signs of potential deceleration. Net flow, representing new client money inflows for the second quarter of 2025, was Euro 164 million, marking a decline of 29% compared to the prior year. If this decline in new client acquisition rates persists, the continuation of the strong AUM growth will rely disproportionately on favorable market appreciation, placing the long-term 10% PBT CAGR target under greater strain. 3.2 Profitability and Earnings Volatility, H1 2025. The group's earnings demonstrate the structural dichotomy of its business model. The capital-light segment proved resilient, generating €40.6 million in PBT for H1 2025, representing a minor 2% decrease. However, the legacy capital-heavy business dragged down overall profitability. Total profit before taxes, PBT, for H1 2025 decreased sharply by 22% to €96.1 million versus €122.7 million in H1 2024, driven primarily by a 14% decrease in the net finance result. Consequently, earnings per share, EPS, declined to 0.16. This high volatility in total PBT mandates that investors critically assess the stable underlying capital-light PBT, rather than relying on the headline EPS figures. Operationally, management demonstrated effective cost control, evidenced by the cost-income ratio related to client AUM improving significantly to 53%, down from 64%. This material improvement confirms strong operational leverage and scaling within the core asset management unit, which is an essential structural defense against potential fee margin dilution cited by external commentary. 3.3 Mandatum Asset Management's competitive edge. MAM's growth is fundamentally supported by its specialized investment expertise, particularly in the Nordic corporate bond market. This market segment offers significant diversification and high return potential compared to traditional European fixed income offerings. MAM successfully leverages the structural advantages of the Nordic high-yield (HY) market. Approximately 50% of Nordic high-Y bonds feature floating-rate coupons, resulting in inherently lower interest rate duration. Combined with typically shorter maturities, this lowers the spread duration as well. This structural characteristic limits price volatility stemming from changes in underlying interest rates and risk sentiment, providing Mandatum with a valuable competitive edge. This differentiated product offering enables MAM to capture alpha and potentially justify premium fee margins, thereby strengthening the foundation for the required PBT CAGR targets even in volatile rate environments. Capital structure, solvency, and shareholder return policy. IV.1 Solvency II Framework and Capital Quality. Mandatum's investment proposition is fundamentally underpinned by its exceptional capital quality and position. The group's Solvency II solvency ratio, calculated without the Transitional Measure on Technical Provisions (TMTP), stood at 193% as of June 30, 2025, maintaining stability from the previous period. This ratio provides a significant capital buffer, well above the newly revised target range of 160 to 180% set for the end of 2028. External rating agencies validate this strength. S&P Global Ratings expects Mandatum's capital adequacy to remain redundant at the 99.99% confidence level over the forecast period. This high degree of capital redundancy substantially reduces the regulatory risk typically associated with insurance investments, shifting the investment focus almost entirely to the deployment of this excess capital. Furthermore, the organic capital generation (OCG) per share improved to Euro 0.34 in H1 2025, up from 0.24 previously, confirming that the core business generates strong, sustainable new capital that supports dividend capacity separate from the structural release of existing capital. IV.2 Transitional Measure on Technical Provisions (TMTP) Unwinding. The mechanics of the Solvency II regime are central to Mandatum's long-term capital strategy. The Transitional Measure on Technical Provisions, TMTP, is a regulatory device permitting insurers to gradually phase in the higher technical provisions required by Solvency II for liabilities originated prior to January 1, 2016. The structural impact of the TMTP is critical for modeling future capital release. The transitional deduction decreases linearly from 100% in 2016 to 0% on January 1, 2032. This systematic unwinding is recognized by management as a key driver of capital changes and influences the group's profit-loss statement. The unwinding process dictates a predictable long-term decline in the solvency ratio, unless offset by strong OCG. The process also generates complex deferred tax liabilities. As of December 31, 2024, a net total of Euro 262 million in DTLs, adjusted for the impact of the transitional measure, was recorded on the Solvency II balance sheet. The successful financing of both the structural decline of the solvency ratio due to TMTP unwinding and the committed Euro 1 billion shareholder payout depends directly on Mandatum's ability to consistently generate OCG at current or higher levels. IV.3 Capital Deployment and Indebtedness. The primary capital deployment strategy is the commitment to shareholder return, formalized by the target of exceeding $1 billion in cumulative payouts between 2025 and 2028. Mandatum maintains a stable credit profile, supporting its financial flexibility. The group reported $588.7 million in financial debt and $1,300 million in shareholder equity as of June 30, resulting in a moderate debt ratio of 24.8%. The debt structure includes $300 million in subordinated Tier 2 notes issued by Mandatum Life, with a 4.5% fixed coupon until 2029 and a final maturity in 2039. The credit ratings reflect the stable outlook. Mandatum Life, the main operating entity, holds a strong A rating, while the holding company, Mandatum plc, maintains a BB+ rating, both with stable outlooks from S&P Global Ratings. The rating differential is typical under Solvency II, where the operating insurer's capital is ring-fenced, allowing the holding company to serve as the efficient conduit for managing the asset management growth and distributing excess shareholder capital without jeopardizing policyholder security. V. Valuation assessment and peer comparison. V.1. Multiples analysis. Rationale for the premium. Mandatum stock trades at a notable premium when viewed against traditional insurance sector metrics, highlighting the unique nature of its business model. The price-to-earnings (PE) ratio is approximately 21.5x, significantly elevated compared to the average European insurance industry PE of 12.7x. Similarly, the price-to-book (PB) ratio of 2.3x exceeds the average PB multiple 1.6x seen among its selected peers. However, the premium is justified by its regional context and structural composition. The 21.5x PE is comparable to close Nordic peer Sampo 21.4x. This suggests that Mandatum is valued within a premium Nordic financial services cohort, distinguishing it from the broader, capital-intensive European insurance sector. The market effectively applies a sum-of-the-parts valuation, a high growth multiple, typical for specialized asset managers, to the capital-light business, and a premium PB multiple to the legacy life business based on the assured prospect of efficient capital release. V2. The dividend discount model, imperative. Traditional multiples based on reported earnings, total PBT, are inherently misleading for Mandatum due to the structural complexity and declining nature of the runoff portfolio. Earnings volatility is high, total PBT decreased 22% in H1 2025. Therefore, the dividend discount model, DDM, is recognized as the most appropriate valuation framework, as the primary investment proposition is the high payout ratio driven by the systematic release of overcapitalized reserves. The stock's expected return is highly dependent on a high dividend yield, currently reported at 10.87%. Analysts confirm that this yield is the dominant factor, as earnings from the legacy business are expected to structurally decline over the coming years. V6. Analyst consensus and market sentiment dissection. V6.1. Detailed review of broker targets. The current market price of Manta stands in significant divergence from the institutional analyst community. The mean consensus target price is Euro 5.48, representing a substantial downside of 11.9% from the recent closing price of Euro 6.22. The sentiment is overwhelmingly negative, with 66.7% of ratings falling into the negative category, sell or reduce, versus only 16.7% positive, buy. This skepticism reflects a belief that the recent strong stock price momentum, 43.26% one-year change, has driven the equity valuation ahead of demonstrable fundamentals, particularly if the 10% PBT CAGR target is not achieved smoothly. V6.2. Dissecting the divergence. The wide dispersion of price targets, from €4.30 to €7, indicates significant uncertainty regarding the true intrinsic value derived from the legacy insurance portfolio. The primary source of this valuation disagreement is likely the differential assessment of the value and associated risk of the Transitional Measure on Technical Provisions, TMTP, and its unwinding schedule. Analysts with low price targets are likely applying a higher discount rate to the future capital release or modeling a higher execution risk associated with the capital-light growth targets. The persistence of the stock price near its 52-week high, despite the negative consensus, suggests that the trading is momentum-driven or reflects the conviction of certain institutional investors who model the Euro 1 billion capital release commitment more favorably than the mean sell-side analyst. This divergence creates a significant risk. Should management fail to meet its committed payout schedule or deliver on the aggressive capital-light growth targets, the stock is exposed to a rapid downward convergence toward the consensus target price. V7.
Investment risks and opportunities. V7.1 Key risk factors. Execution risk on capital-light growth. The failure to achieve the mandated 10% plus capital-light PBT CAGR, particularly if international institutional growth yields structurally lower fee margins, will undermine the premium growth valuation applied by the market.
Capital market volatility. Adverse shifts in interest rates or widening credit spreads could introduce high volatility into the net finance result of the legacy with-profit portfolio, negatively impacting overall reported earnings and obscuring the success of the capital-light segment. Shareholder payout failure. The valuation is critically dependent on the DDM framework. Any regulatory hindrance or operational setback that forces a delay or reduction in the anticipated €1 billion cumulative payout would immediately shatter the investment thesis, likely triggering a severe correction toward the lower band of analyst targets. TMT regulatory risk. Although the TMT unwinding is scheduled through 2022, regulatory changes or stress in the financial system could compel supervisory authorities to require an accelerated or revised recalculation of the measure, potentially locking in future capital that was earmarked for distribution. 7.2 Key opportunities. Sustainable high dividend yield. The commitment to the new lower Solvency II target range 160 to 180 while maintaining a 193% ratio provides substantial capital headroom, ensuring the current high dividend yield 10.87% is structurally sustainable through the 2028 payout commitment period. Operational leverage accretion. Continued improvement in the cost/income ratio related to AUM, currently 53%, will drive robust earnings accretion, creating greater internal financing capacity to achieve the ambitious PBT CAGR target. Outperformance in specialized assets. Successful expansion and capital flow into Mandatum's spearhead products, particularly Nordic High Yield, confirms the firm's ability to capture alpha and maintain premium fee margins, offsetting broader market competition in generalized asset classes. 8. Detailed Appendix, Solvency II and Regulatory Nuance. 8.1. Detailed Solvency Capital Requirement (SCR). Mandatum Life utilizes the Solvency II standard formula for calculating its solvency capital requirement, SCR, which stood at €802 million as of December 31, 2024. The composition of the required capital is crucial for assessing risk exposure. Market risk, €897 million. Life insurance risk, €304 million. Operational risk, €35 million. These capital requirements are partially offset by diversification benefits totaling €202 million. Furthermore, the loss-absorbing capacity related to deferred taxes significantly mitigates the requirement, reducing the solvency requirement by €201 million. This detailed breakdown confirms Mandatum's sophisticated and compliant management of regulatory capital, supporting the high overall Solvency II ratio. 8.2. Mechanism of the Transitional Measure on Technical Provisions, TMT. The TMT is a cornerstone of the group's long-term capital planning. The measure permits a transitional deduction that corresponds to a portion of the difference between technical provisions calculated under the previous solvency regimes and those calculated under the Solvency II regime at its inception. This transitional deduction is designed to decrease linearly over time, starting from 100% in January 2016 and reaching 0% on January 1, 2032. Management explicitly accounts for the unwinding of this measure as a factor influencing the organic capital generation and the profit/loss volatility. The associated accounting complexity is evident in the fact that a net total of €262 million in deferred tax liabilities must be accounted for on the Solvency II balance sheet, reflecting the long-term tax consequence of this phased capital adjustment. 8.3. Indebtedness structure and Tier 2 capital. Mandatum's financial resilience is supported by its moderate debt levels. As of mid-2025, financial debt was €588.7 million, substantially covered by €1,350 million in shareholder equity. The core structural debt instrument is the €300 million subordinated Tier 2 note issued by Mandatum Life. This instrument has a 15.25-year tenor, maturing in December 2039, and carries a fixed 4.5% coupon until the first call date in December 2029. The subordinated nature of this debt contributes to Mandatum's eligible own funds under Solvency II, further bolstering its capital quality and ability to meet the regulatory minimum requirements.